There was a lot of uncertainty with Jerome Powell. He calmly talks about all of this, but the words that he uses is uncertainty, unsure about economics, about the economy, and as well as about how many interest rates are going to be needed to do cuts. So all of these things to me tell me the Fed is trying to land this plane smoothly, but they are acutely aware that there are many hurdles that they still have to go through. And remember, even with the CPI data coming in this morning better than expected, a lot of that was because gasoline and oil fell about 9%. And so again, you have to look at it and say the Fed still has inflation north of 3%, and they're now talking about cutting rates, but now it's only one cut. When does it go to no cuts? Maybe next year, even less cuts than they're saying as well. You have to look at the stock market, and the stock market continues to make new all-time highs. And I see literally zero chance that the Federal Reserve will cut rates until you see a significant pullback in the stock market. When we're talking significant, I would say it has to be at least 10%. So if we don't get a 10% pullback by year end, then you're not seeing the Federal Reserve cut this year. And again, look at it from this perspective: is the higher the stock market goes, the more inflation there will be in the system, or at least harder it is for the stock market to bring down inflation because of the wealth effect. Remember, everyone's looking at their 401ks, and at least those that have investments. We know that the lower to middle income brackets are struggling. I mean, that is no change. We've known that now for months. The higher income, they have investments, and every day the stock market making new all-time highs makes them feel richer, and they go spend, and that creates a demand size movement where you're seeing more demand for goods, and that pushes inflation basically neutral to higher. The Fed seems like they don't want to actually put the kibosh on the stock market and really force it down. But if they don't force it down, then you're going to see inflation stay north of 3%, and it's going to make it almost impossible for them to cut rates in the future. The other side of the coin, too, is that this Federal Reserve intervention, and this has gone on now for decades, has literally caused this massive divergence between the rich and the poor, right? If you're rich and you have money to invest, then if you have a drawdown in the economy and people lose jobs, the Fed lowers interest rates, allowing those people to borrow money. It pushes the stock market up even more. If the economy is strong, then they raise interest rates, and you talk literally about hundreds of billions of dollars in interest payments that are now being made to these high income individuals, making them richer, while the lower income are struggling to afford the inflation at McDonald's to feed their family. So again, this has been from the very start one of the worst scenarios. It all started, in my opinion, with the dual mandate. Once the Fed had to be concerned about employment plus the banking system, that's where honestly this began. I've always been a doubter. I've been a non-believer in the Fed. Historically, the Fed does not have an accurate, track record of engineering these soft landings. And really, if you look at it, they're in a hard place. I mean, I don't envy their position, even though it's somewhat self-made. But ultimately, I don't see how we get out of this without some sort of corrective move. And by the way, if they cause the stock market to come down, you're going to see a recession, right? That's going to cause businesses, Apple's, the Googles, all of these companies that still are already cutting jobs, they're going to have to cut more as consumers pull back. And I think one of the things to keep in mind for people is you have to look at the tea leaves, right? We've seen the latest earnings come out. We saw Starbucks, Disney, Expedia, traveling. A lot of these areas are starting to see the consumer pull back just a little bit. You still have the high-end consumer willing to spend, though, and they are keeping this economy on life support at this point and spending enough to keep the merry-go-round going. But if anything happens to that stock market, you will see the higher end start to pull back as well, and then recession follows very quickly. So no, I don't think the Fed engineers a soft landing here. I do think that we're on the verge at some point here in the next few months of some sort of bigger correction. There's rumors about the banking system going on there. Whether or not that has teeth, we'll get into in a little bit, I think. But ultimately, there are so many kind of issues out there, whether it's China, Taiwan, whether it's the banking system, whether it's the economy here, whether it's Ukraine, Russia. There's enough out there to create instability that I do think you'll get a big enough pullback in the market that the Fed will step off their seat and actually cut rates. But remember, historically, when the Fed cuts rates, that's actually when the market accelerates to the downside, not actually starts going up. If you talk about 2025 and going out into 2025, I think it's much more than that. I mean, we could be looking at 35% drawdown by mid-2025. And again, you named a bunch of the things, and I agree 100% that there are so many risks out there. And then even just the normal macro, the slowdown in the consumer, the stretched consumer who has $1.1 trillion in debt, and that's not even including phantom debt, which is like $700 billion on the backs of them. You throw in auto insurance, which has skyrocketed, home insurance insurance has skyrocketed, the cost of money, the mortgage rates, and all of these things are just weighing investors down or consumers down. And that's not even to mention what it costs to now go out to a family restaurant like Applebee's or Chili's. So these are things that eventually you will get that straw that breaks the camel's back and cause a bigger corrective move. And right now, euphoria is in the markets. AI is the leading thing, but I would just point out that in every major bubble before every major collapse, there was always this same euphoria. And last thing I'll say to you, I was called bearish back in 2007. I said, guys, there is something bad that it's going to happen. Everyone laughed at me. And then we had 08, 09. I'm feeling the same way. The hairs on the back of my neck standing up. Something is happening here. People need to be very careful. Listen, in 07, I was early. I was about 8 months early. I started warning in early 07. We didn't see the markets top out really until late 07, early 08. And there was upside I missed there. And this is the thing is, right, as a logical, technical trader, I see the things out there, but you have to also take into account, and this is something I still struggle with, is taking into account human emotion and the effect of FOMO. FOMO, people just wanting to chase even when the factors are not there. For instance, I look at the PE ratios amongst the large trillion-dollar companies. You know, historically, does it make sense that they're trading between 30 and 40 PEs? No, but ultimately, as long as investors are willing to chase gains like this, they can keep going higher in the short term until the music stops, and that will end up happening. But no doubt, I have been early in this scenario like I was in 07 into 08, but it will come, in my opinion, and it's not going to be pretty. And listen, I want to be clear on this. I would say there's a good 40 to 50% of the population in the US that already feels like they're in a recession. But in terms of the data and the analysts and the economists calling it a recession, I think that probably takes place in early 2025. It's the beginnings, right? It's the step just before the Federal Reserve cut rates. So they're obviously seeing something, right? They're seeing something in the data that they're not sharing with us that is making them slow down. And this is another pet peeve of mine, that every crisis, their balance sheet, the Federal Reserve's balance sheet, balloons by 100 to 150%. And then during the good times, quote unquote, they reduce it by 15%. And just to give people an idea, they ran the balance sheet up during COVID to 9 trillion and change, and they've gotten it back down to 7.5 trillion. Prior to that period, it was probably $4 to $5 trillion. So you look at that and you just see the longer term impacts of what's going on. And people like to say the Fed is independent, their debt doesn't matter. It is still debt, folks. You and I in the US, we are responsible for that. You might as well add it to the US deficit, the debt in the US, and add it up there as well. But you're right, when you're talking about the rundown, the slowdown of their runoff, it is a way of them actually cutting rates without taking that step to cut rates. And I want to be clear on this. If we go to my chart here, we can talk some levels. So this is the S&P 500 chart right in front of us here. And what we have is a couple trend lines that I'm monitoring. This first trend line takes from the COVID lows to the panic March 2020 lows, and it goes to the recent highs, and we just tagged that today. Now, whether or not that's a top, we don't know yet. We don't know until after the fact when we look back on it. If we do go higher, there's an incredible trend line here that goes back to the 2009 lows that connects through the 2021 highs, and that's just a little bit higher at around 55 to 5,600. My guess is the top is very close, if not at hand. Now, in terms of a drawdown, where are we looking? Well, all you have to do is basically connect major recent lows, and we can do that and then do a measured move here. So what we do is we'll just draw this through these two lows, and what we get here, and this is probably a good chance for a year-end calculation, is we take the current levels, we drop a line right back down here, and to me, that's looking like about an 18% correction on the S&P, potentially by year-end. Now, this doesn't take into account if we really slip into a recession that gets bad in 2025, then you could be talking about much, much lower levels. But I think by year-end, 18%, retesting that major trend line would be very, very likely. This is the key, is that initially people will get excited about the cuts. And then what you see historically, and if we look at the data from past scenarios where they've started to cut, what actually ends up happening is that the investing public begins to worry that the Federal Reserve is going too slow, and they're starting to panic. And this is the wave of emotion from massive greed that we've been seeing to go all the way towards the fear side. So when the Fed starts cutting rates, historically markets actually that's when we start to see selling, because they start to be concerned the Fed is not moving fast enough to avoid a major drop like 08, 09. So in theory, if you look at the data again, it's when they cut rates that the market actually starts to sell off dramatically. We all think about the Black Swan events, the what if China invades Taiwan, what if the war in Russia in Ukraine gets bigger and envelops more countries. But in reality, it's probably the U.S. economy. And with the slowdown in consumer spending, we've all been told for decades that the consumer is the backbone of the U.S. economy. If we start to see selling or a slowdown in that consumer, and the consumer stops buying, that's where you see the PE ratios that some of these companies are trading at. Like, think about how much impact. You now have 6 companies, right? Microsoft, Apple, Nvidia, the trillion-dollar names. They literally make up over 30% of the S&P 500. 494 companies are less than 70% of the S&P 500 now. And so if you get a slowdown and you have these mega caps trading at 30 to 40 forward PE ratios, and they go back to even just a general norm of historic PE ratios, let's say 20, you're talking about 40% downside in those stocks, which will easily crush the stock market down at least that amount as well. So really, again, there is the most likely scenario is that you get a slowdown in the US consumer, and then that's what takes the markets down. There's no doubt that if we start seeing more and more cuts from these central banks, the Fed will have to do something. In fact, they'll be forced into it. Now, the bigger question will be is where is inflation at that point? Is it coming down enough? And the Fed may fight that. The Fed may stay the course as long as they can until you see the stock market forcing their hand to cut these rates to more normalized levels compared to other countries. And just one more little tidbit that I'd just like to throw in there. I didn't mention this as a black swan / risk for the markets, but the dollar yen is a major risk for the overall economy and the US here. Remember that the Japanese central bank intervened just about a month ago to push their currency back up against the US dollar. We've now started to see the Japanese yen starting to weaken again. And the way that the Japanese central bank basically strengthens their economy or their currency is by selling US bonds. Remember, they're the biggest holder of US bonds. And so if you start getting a lot of US bonds being dumped on the market, and there's a lot of talk that China's already doing this, they're dumping US debt to buy gold. And we've seen the gold numbers go crazy over there. You actually have a scenario where the Fed may be unable to really lower real interest rates significantly if it gets to that level. So again, not something that's likely, but it needs to be on an investor's radar.